There are some key metrics that I think every business should pay attention to. Split between really the profit and loss and the balance sheet primarily. And what they will do is give you a really good understanding of the financial performance of your business and also the financial health of your business. If we start with the profit and loss type metrics, key thing for startups will be burn rate. You've raised a finite amount of money from your investors. What rate are we burning that cash at? How many months of runway do we have? Really key metric. Number one metric in a venture-backed business is burn rate, and making sure that's as optimal as it possibly can to achieve the growth you want. Growth rate, in terms of revenue as well, huge. So if one of your metrics is growth, focusing on your growth rate is key, and making sure you're regularly on top of that and comparing versus your targets. And then some key performance measures on the profit and loss is gross margin. So what percentage of my sale do I keep before paying my overheads? So my revenue minus my direct costs of producing that revenue and that sale, what am I left with? That's a really key number, and that's usually expressed in the percentage as well. For a lot of business, that's really the make or break of the business. If your gross margin is not correct or effective, there's absolutely no way your business can be successful. So that's a really, really key number. And then the EBITDA margin, which is really a number towards the bottom of your P&L, which takes into account that gross margin, but also all of your expenses and overheads. What that really does is gives you overall how effective is your business at generating profit, which then will affect cash flow in the future. So those are the main items. So burn rate, growth rate, gross margin, and EBITDA margin are the four main areas I think businesses should focus on in terms of high-level metrics. When it comes to the balance sheet, so assessing the financial health of your business and cash flow, some areas I would say businesses should focus on would be debtor days, which is effectively a metric of how long it takes your customers to pay you. Now, the quicker your customers pay you, the quicker their cash is in your bank account, and the quicker you can deploy it on some other growth activity or something else. So you really want your customers to be paying you as quickly as possible. Not always relevant to every business, depends on the type of business. Some people get paid up front, but a really key metric. Creditor days, which is really how many days on average does it take you to pay your suppliers. Now, this is about finding a balance here. The longer you can push that out in an ethical manner, the better your cash flow is going to perform. But again, you don't want to push that out too far. So it's really about finding balance. Debt to equity ratio as well. If you're a highly leveraged business or you've got a lot of debt in your business, making sure it's in line with healthy benchmarks is really key. So keeping on top of those ratios, and debt repayment cover and interest cover as well, which is really a measure of making sure the business is making enough EBITDA. So that kind of operating profit number that I mentioned to you, not exactly the same as operating profit, making sure the business is generating enough EBITDA, which is earnings before interest, tax, and depreciation and amortization, making sure that's sufficient to cover your debt repayments. Some metrics that I think are really key for consumer goods businesses that they absolutely should be focusing on that can have a massive impact on your business, success or failure. Inventory days. So how many days is my stock tied up in my balance sheet, my inventory, before it gets sold? Optimizing that as much as possible can have a massive impact on your cash flow, which then frees up that cash to invest in further growth, for example. And customer acquisition cost to lifetime value. Really key metric. I think a lot of people are really hot on this right now, but it is really the number one metric for growth for consumer goods businesses, any business, to be honest. How much am I spending to acquire a customer? And what is that in relation to what that customer is worth to me over the lifetime of them being a customer with the company? Now, a good ratio for that is 3-1. So you want the lifetime value of the customer to be 3 times that of what you've paid to acquire them. That's really a good benchmark.